Welcome back. Maneesh Dangi from Mosaic Asset Management is now with us to join to talk more about the markets and macros. Maneesh, thank you very much for joining in. Just last week we were discussing, I mean, not with you, but the markets were worried about the U.S. bond rout. Trump's tax bill, Moody's downgrade of their U.S. credit rating. How are you assessing the U.S. macros first?
Hi. So the U.S. essentially, the whole thing of the MAGA that they've got the tax cuts, but spending cuts are not coming in. And so to that extent, the old US template of good last 10 years of running very high fiscal deficits seems to continue even in this regime, and which is why, bonds are not liking it. Rates have backed up substantially in US since Trump came in, and it continues to sort of happen. All of that actually impact is more visible in places like Japan, where the bonds are actually backing up even more substantially. So in a sense, it's for the bonds. You sort of intermittently in US at least, it doesn't seem to. You don't seem to have policy support. Is how I can read it. Every time it sort of seems like that they're going to be growth slowdown, and which will result in lower rates, and therefore the long bonds actually start to price in. They price in also, and there comes a little bit of a fiscal googly, and you sort of see rates back up again. So that's how one has to read it. It seems US does not have the sort of appetite to actually tighten fisc at any given point in time. They loosen. So that's how I would read the macro there.
Maneesh, good morning. Thank you for joining in. Does this mean, with this current bond market volatility that you're witnessing, that the longer tenor bonds are an absolute no-go? Because the 40-year bond auction that just happened in Japan had a very poor response. Even the 30-year bond, the 20-year bond auction that happened in the US earlier this week, that too had a very poor response. But the 2-year bond auction that happened yesterday, that had a very good response in the US. So it means that the shorter tenor bonds, okay, but the longer tenor bonds right now is an absolute no-go, considering you just don't know what's going to happen in that long.
Yeah, so long tenor bonds is where you read the macro right. Short tenor is so much to do with many other things, and of course they are very adjacent to the Fed rates, and liquidity is an issue there. So my sense is that long tenor is where you have a good resolution of how markets at least read how macro would behave over a medium term, and for equities or for general view of that economy over the next few years. For mortgage rates, what matters, of course, is what long tenor bonds do. It's a mix of things like, the long tenor bonds refuse to believe that US inflation would sustain at low level, but more importantly, they're actually pricing in much higher real rate given the fiscal pressures. And of course, there also have to be pricing in a sustained possibility of sharp devaluation of dollar at some point in time. And so I don't know, what all Trump would be able to achieve, but for sure, one thing that he will be able to achieve is a significant dollar weakness, I think. And that's how I would read, how the bond and the currency are tangoing right now.
Okay, so you expect the dollar to weaken from here on. On the Indian currency, given the fact that RBI is flushing the system with ample liquidity, what is the call on the Indian currency, say by the end of the calendar year, in terms of more cuts from the Reserve Bank of India, and how it affects the bonds?
So with such sharp easing in liquidity, rate cuts, and of course weakness in economy over last 12 months, we of course initially, we saw our currency weaken, but the fact that it's sort of in some sense unwound some of the losses. Sort of tells you that a big global macro trade is supportive of emerging market currency. So my general view for next couple of years would be that the depreciation run rate of INR would be a lot lesser, and I wouldn't be surprised. I would say sort of 1 in 2 chance that INR remains here or actually sort of becomes stronger over next 1 to 2 years. So that kind of a regime invariably does not happen in weak growth environment, but again, tying it with what is happening in US, it's more to do with dollar, and which is why, INR actually will most probably stay strong. INR strength or INR stability also gives a lot of space for RBI to actually do a lot of things, substantial easing in liquidity, rate cuts, and so on and so forth, and regulatory easing. All of that is only possible in the last 4-5 months because INR has been sort of last 2-3 months particularly because INR has been sort of stable or appreciating now.
Since you mentioned the dollar, Maneesh, I was just reading a note from JP Morgan where they had asked a very pertinent question that is this the start of the dollar downfall? Where they do say that, of course, they are expecting a few more percentage points of depreciation for the dollar. They don't see a very substantial or a significant crash from these levels. What do you think about where's the dollar headed here? It's been meandering around this 98 to 100 range. But do you see the dollar weakening further, and does that mean that emerging market currencies will fare a lot better this year compared to the dollar?
So a couple of things, right? From purely valuation standpoint, dollar relative to any currency, more specifically developed market currencies, is very strong. And so if fundamentals were to sort of get priced in, dollar should be weaker by 15-20%, depending upon how you sort of look at various indices. So that's fundamental. Two, historically also, last 50, 100 years, you tend to see these 10-15 years of strong dollar and thereafter weak dollar markets. We've had a very, very strong dollar market since GFC. This is 2008. I wouldn't be surprised if we are rolling into a period of weak dollar setup. So sort of that's pure empirical way of actually looking at it. Third, of course, is the policy itself. After very long, almost clearly, the U.S. administration seemed to be hinting that they need weak dollar, and to that extent, all policies would sort of align to ensure that their currency actually weaken in order to, of course, get manufacturing back and so on and so forth, whatever they're wanting to do. So all of these things sort of point at a picture, which is perhaps going to drive dollar weaker over next couple of years. So very, very different regime than what we've seen since 2007.
All right, Maneesh, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. We take a short break here, but just before we do that, here's some good news for our viewers. And India's business news leader is now just a click away. Introducing CNBC TV18's all-new app, where you get instant access to breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screens to download the app. Take a short break. Back on the other side.